Right guys, welcome to a brand new video. Today I'm basically going to try and do a bit of a more of an in-depth video on options. So yesterday was a busy day, so I tried to do a video talking about stocks versus options, which I think is very important because the amount of learning that I've had to do, well, not had to do, I've chose to do with options, it was actually a bit addictive. It was actually a little bit it got to the point where, when I want to learn something, I'm not like the average person where I just take someone's advice and that's it. I could show you my YouTube history, I could show you my internet history, the amount of hours I've put into actually learning options is actually quite sickening. It's actually a little bit worrying. I mean, I've put in a lot of time, so I can understand some people seeing that they see options trading and then kind of just close the door, so to speak. But I want you to know, from my point of view, is I feel like this is the better option, okay? And I want to explain why. But before I do that, I'm just going to try and give you a bit of and excuse me if I look a bit tired. I've literally woken up about half an hour ago, so I'm just going to the gym soon, so I'm just taking my pre-workout and then I'm going to make this video and then get to the gym. So what do we have in options world? Well, okay, so this is Tastyworks, okay? This is the platform. Now on the left hand we have the symbols, we have our watch list. The IV rank stands for implied volatility. The volatility is obviously what makes a stock move. The higher the volatility, the higher the volatility, volatile, the stock is going to be more volatile. I hope that's self-explanatory. The lower the volatility, it speaks for itself, the less volatility. Now we have, this is the table, okay? This is called the table. We also have a curve, and we have the active, and then we have the analysis. We're going to stick to the table today. The curve is quite straightforward in the way that once you set up like an iron condor or a straight vertical or any other kind of, these are the options that you can choose from. So for example, we have an iron condor, okay, basically like a strangle but more secure. So you're basically strangling the stock at a certain price, but you also have the protection as well. If we do a strangle, okay, this is no protection. So you're basically strangling the stock at a certain price, 340 and 360, but there's no protection. So you do an iron condor, then you now have protection, okay? So you're buying and selling, so you've got that buffer. Anyway, let's just not do any strategy right now. So let's just leave that for a second. So this is the table, okay? Let's just go through the table. So we're going to buy. So the option is basically, an option gives the buyer the right and the seller the obligation. Now each contract has an expiry date, as we can see here, January the 18th, January the 25th, and this tells you the day. Okay, so we've got the day here. It says strike there, but don't pay attention to the strike just yet. So we've got the 3 days, 10 days, 17, 24, 31. Now, with options, you have something called time decay, okay, which is fader. Now, fader, if you buy a contract for, let's say, which is called weeklies, which you buy, let's say, in 3 days' time, you're going to get fader decay, which is called time decay. So basically, the longer your contract is outstanding, or the longer you hold on to your contract, the more time you lose. So your contract becomes less valuable, because the way you got to look at it, if you're kind of betting or forecasting that, let's say, Apple's going to go to 150 and you buy your contract for 140 and you have 3 days left, the less time you have for the stock to move up, the less valuable your contract becomes if the stock doesn't move. However, if the stock does move in your direction, then obviously the contract will become more valuable. So let's just open one of these contracts up and let's have a look. So if we go on to January the 18th, 2019. So what do we see? Right, so we have the delta, okay? We have the open interest, we have the bid and the ask. Let's try and keep this fairly simple, so I don't want to confuse anyone or disparage anyone from, getting into options or understanding options. So we have the strike, And then we have the puts, the bid and the ask. Let's just keep this simple. So if I'm forecasting that Apple so let's choose Apple. So let's, for example, say that I believe that, let's say hypothetically, Apple's going to reach 154. Maybe. This is not a full technical analysis on Apple. I'm just saying, you know, we've got some resistance up here. Let's see if we can try and get to 154. So if, for example, let me just get my horizontal line. Let's just put a line up here. Let's say if I want to buy Apple, let's say 154. Okay, let's go onto the option chain. So let's go on to trade. Now let's say in about 10 days time, to give us a bit of, you know, a bit of a buffer. So we go onto the 10-day contract. How do we know it's the 10-day? The 10 days are here. So the times are in the middle. You could buy a contract for 885 days out. Obviously, it's going to cost a lot more expensive. So, for example, if we could say Apple for 150, the calls for 150 are going to be $4.55. If you went out to 855 days, you can see the 150 calls are going to cost you $30, which is going to $300 a contract. So you can see the longer you go, the more expected it's going to reach. So the more chance you have. So if we go into the 10-day contract, let's say we want to buy Apple at 150. So we have to buy the call, okay, which we have to then buy the ask. So the call, you're going to have the bid and the ask on the call. So we have the bid here and the ask. Now the bid is what you sell it at, and then the ask is what you pay. So for me, I'm going to be buying, so I'd be paying $4.55 per contract. Okay, and if I wanted to sell that again straight away, I'd sell it for $4.50. So that, you know, the 5-cent increment there is what the market makes. So that's the market makers. Okay, you're always going to have a difference in between bid and the ask, which is the spread, because the market makers have to make, that's how they make their money. So you got to be really careful with the spreads. Some spreads are like 20, 30, 40. I've even seen $1.50 spreads. So when you're trading, make sure there's no more than at least 5. I mean, I'm trading, this would be 5-cent increment spread. I wouldn't go any higher than 5 cents. So for example, I'd buy the call, okay, for $4.55. And now you can see the price is 150, okay? Apple's price is currently 153.10. So if Apple goes up to 155, this is going to come in the money. Okay, so this is going to become in the money, which basically means, as you can see here, in ITM in the money, and then if you were shorting ITM here is in the money. So Apple would become more valuable. So this would go from 455 and it would increase the higher the stock goes. Now, what's the benefit to this? Let me just give you an example. So this is allowing us to control 100 shares of Apple for $4.55. 100 contracts, 100 shares is one contract. So it actually cost, so 455 times 100. So it actually costs $455 to control 100 shares of Apple. Now, why is that interesting? Right. So if I switch over to my other screen, okay, the reason this is interesting because if I wanted to buy 100 shares of Apple, okay, and let's just say the same thing. Let's say the same thing, 155, which is, okay, let's be precise. So 155, okay, that is going to involve just so you can see this, that is going to involve a 1.3% increase. Okay, so let's say for me to buy Apple, for me to buy 100 shares of Apple, okay, so for me to buy 100 shares of Apple right now, it would cost, if I get the calculator out, so for me to buy 100 shares of Apple would cost 100 times 153.10, which would be 15,310. Okay, and I'm only going to get, if I'm right, I'm only going to get a 1.3% increase. Okay, which is $160, $170. Now I could buy that same prospect, or that same option in a sense. That's why they're called options. You can now see the clarity between the two, the distinctions. That's why the options, you have lots of options. I could now buy that contract for $455, I switch over, I could now buy that same contract. So I could now own Apple, okay, for 100 shares for one contract for $455 right here. And once it goes to 149, this contract is going to go up to maybe $5.50, $6. You can see, for example, each one of them going down are a lot more expensive. Okay, so if you wanted to buy the 147, it's going to cost you a lot more to buy the 147 because Apple is what, 153. So if you wanted to go long, okay, if you wanted to go long, for example, so you can see the cheaper they are. So you can see here, Apple 170 is going to cost you 4 cents. Okay, so £4 a contract, because for Apple to go to $170 in the next 10 days, the market is saying that this has a chance of 1%, okay, negative 1%. But for Apple to go, let's say this is in the money. So if we go to 455, which is what we said, which is in the money already, you've got a 41% chance of that happening. And then if you said you wanted to sell that back to the market at, let's say, 148, you've got a 30% chance of that happening. Your max loss is $47. Your max profit is $153. What about if you wanted to sell it back? There you go. Your max profit is now 73 with a loss of 27. I don't normally set them up like that. I normally just buy the contract. So I see, let's have a look. So I see the chart. You know, I see the chart. Let's have a look on the 15-minute. So I see the chart. I can see we're coming down to the EMAs. Let's say hypothetically, like say 154 is where, you know, we might surpass in the next, let's say, 10 days. So I'd go onto my trade. We're already on the 10-day. So we click on the 10-day. We said, just to make sure, we said 154. So if we can try and find one which is at 154, the closest one we have is 155. And now this is interesting. So the next one lower to that is 152.50. The cost is going to cost us $2.92 or $1.68, and there's a $2.50 difference between the price. So you could go for the one which is cheaper. You can see this one has more volume, more open interest, 6,900, and this one's only got 3.8k. Now, so this one is cheaper. Obviously, it's not in the money yet, but the higher the stock goes, the more likelihood that it's going to become in the money, and then obviously your contract will double, quadruple, and so on. Okay, so let's do an example of a short. So if we just clear this leg here, let's say we want to buy a put. So let's say, for example, I see Apple and I have a different perspective, and I feel like we could probably come down to the 200 EMA, which would be, let's say, 151. Okay, so we go back onto the trade, we go onto the contract, okay, and we say, right, where's strike price? The 151. So the first thing you want to be looking at is the nearest strike price to 151. So here we have 150. Okay, so we click on 150, and you can see here we've got the bid and the ask. Okay, and you can see there's a 5 cent increment spread. You can see this one's only got a 3 cent spread. So if we click on this one, this is now telling us we're going to have the 150 put, and it's going to cost us $1.36. Okay, so that'd be $136. As you can see here, max loss is 136, max profit nearly 15,000. Okay, so this is your fader, so you're losing $11 per day. With time decay, this is the thing with time decay, so you have to be really on the ball with time decay and fader. So that would cost you, okay, $136. And then if you shorted it at 150, okay, and then let's say you sold that back. So then if you sold that back for 152.50, you would then have a max profit of 88, max loss of 162, and the possibility of that happening is 58%. Now, you're basically 50% gain. So the maximum you can lose is 162. The maximum you can gain is 88. Now, like I say, you don't actually have to, have a double leg or a single leg. I mean, you have to have a single leg, but you don't have to have a double leg. You can just say, right, I'm going to buy the 150 call, okay, the 150 put, sorry, for $136, and then you can watch that contract increase in value. and then you can sell that on, and once you buy it, you can then sell that for like 150. So you could type in here 150, get a 14 cent increase, and then, you know, go on with your day and sell that on the market when it hits that price. So just to show you some examples, so if we go on to the past 7 days, for me, for example, I can just give you, so this was my first trade here. So I brought a contract for 46 cents. And then 5 minutes later, we can see here 6:42 and 6:47. This is a 12-hour clock, so it was actually 20 to 7 at night time. So we have a contract I brought at 46 cents, which was $46. And then I sold that on 5 minutes later for $67. That's a $21 increase, which is a 50%, nearly a 47% increase. So $46 turned into $67. You know, that could have been 4,600 into 6,700, you know, however you want to word it or look at it. It was still a, you know, 46% increase. And then we had GM 13 cents to 18 cents. Some others on here, you can see we had, let's just have a look. So we had X, so I got in at 34, sold at 37. Facebook, we got in at 63 and sold at 72. So these are kind of just some of the examples, but that's basically, you know, a bit of a more in-depth way of looking at it. Calls for going long, puts for going short. You've got the bid and the ask. Look at the open interest, the delta. The fader is really important. Up here we have the IV rank. So this is telling us in the next 10 days, this stock is either going to go up or down 4%, 4.18%. And the IV rank, the implied volatility, is at 27. So it's quite low. Anything over 50 and 60 is classed as quite high. Anything below over 70 is really high. Anything below 40 and 50 is relatively normal. Below 40 is not that low, not that high at all. So I mean, I think that gives you a full view of actually how it actually looks like on the screen. I don't want to overcomplicate things and have all the Greek symbols on here just yet. If you get a full understanding of how to actually put on a trade and execute a trade, all the other details will come in time. So like I say, I want everyone to be able to trade efficaciously. We don't want to just be a failure. You know, a lot of us are callow. A lot of us are new traders, inexperienced traders. So it's, even I would class myself as, you know, I've only been trading about a year and a half. So I'm nowhere near, you know, efficacious or where I'd want to be, you know, successfully, I guess. I'm not on that pedestal. I'm still new in my career, hence I'm taking things slow. But I do believe that trading options gives you a better chance of succeeding. Why? Well, because we get to trade successful companies. We get to trade Apple. We get to trade the SPY, which is the index which holds this S&P 500, which is an index which holds 500 of the top performing companies in America. You know, we have Facebook, Amazon, Netflix, all these companies. We are trading with options. Why is that important? Well, it's important because we don't have to trade penny stocks. Everyone thinks you're going to get rich if you trade penny stocks. Yes, these stocks go up 100%, but they come down 100%. It is near enough impossible to get the right entries and exits on these penny stocks. Maybe it's me, but I tried it, made some money, lost some money, got damaged in the process, learned options, feel a lot safer, feel like I can breathe. I don't have to put a lot of money into the options. Okay, so I'm not risking that much. The maximum I'm risking so far is $80. The maximum I've got back was $36. So I'm not risking a lot, okay? But you could say I'm not gaining a lot. But, you know, I started the account with $500 and now have $550 after today's close. So that's a 10% increase. But the interesting thing is the maximum I've actually traded is $80. And I've got back year to date, 2 days, $53. So you can see the difference between having to put in, I mean, on a penny stock, even if you put in $1,000, you know, for the stock to go up 10%, you're talking $100. But you have to put in $1,000. I don't even have $1,000 in my account. I'm making sure that I don't have emotional attachments with this account. I'm making sure that I'm putting on the trades, but I don't want it to affect me emotionally. So I'm keeping the trades so small that it's kind of like, if it works, it works. If it doesn't, we'll take it off for a $10 loss. If it works, we'll get a $20 gain. So it makes it a lot easier for me when I'm only trying to make $30 a day. $30 a day is $150 a week, $600 a month. You know, it's about £500 for me in the UK. That's a lot of money for me to pay. That can pay all my monthly bills. So I've got to look at this with a rational and logical mindset. You know, even $100 a week. Another thing, I don't have to pay for a platform. Short Trader, $100 a platform. TradeNet, I think there's only about $20-$30 a month, but the commissions, no commission. I need to pay $1 for a commission. So to buy a contract and to sell a contract costs me $1 for the round trip. $1 to buy the contract, and to execute or to sell the contract is free. So to buy to open, so you buy the contract to open the contract. So you buy a call or you buy a put to open your contract, and then you sell that. Okay, so you buy to open and then you sell to close the contract. Okay, so opening the contract and then closing the contract. Buy to open, sell to close. The only reason I repeat that like that is because people think when you sell a stock short, you sell the contract, but you actually have to buy the put. In trading, you actually sell the contract, but in options, you buy any contract to open the position. So if you want to go long, you buy a call. If you want to go short, you buy a put. You want to close that position, you sell it, and then you close. You sell and you close. So like I say, so much less expensive. I'm not paying anything for my charting. My charting is free on TradingView. My platform is free on Tastyworks. I'm paying $1 commissions, and I mean, that's basically it, really. We're trading actual, you know, well-known companies, indices. We're not having to mess about with penny stocks. And hopefully this gave you a bit more of an in-depth view of how to buy and how to sell, how to go short, how to go long, the bid and the ask, the strike price. If there's anything I left out, which I probably have left out because I'm still trying to wake up. So if there's anything I have left out, please ask the questions in the comment section below. I will get back to them really quickly. And I think that's it. So if you've enjoyed the video, give it a thumbs up. If you haven't already subscribed, please do so. That'll help me help you. And other than that, guys, I will see you all in the next video.